All right, today, May 5th, Cinco de Mayo, we're going to go over a very important topic. The topic is trends. Now, if we look at the trend today, this is the NASDAQ. Will we all agree that the NASDAQ today looks more bullish than what would be normal in the NASDAQ? Will we all agree that the NASDAQ looks more bullish today? Bullish, in case anyone doesn't know, means going up. Does it look more going up? Right, aggressively, correct? This is not your normal day. If this was like a normal day in the market, if this was every day or most days in the market, everybody would have money in the stock market because who would not want to take advantage of that, right? Everybody would say, "Hey, man, I want a piece of that action," right? Okay, so let's run an experiment. Just a simple experiment. Oh, I just realized something is blocking my recording. Let's do a simple experiment, okay? Now, I have to use Thinkorswim for this because TrueEdge is not designed for this functionality, but here's what we're going to do. We're going to do a back test, okay? Thinkorswim is capable of back testing. TrueEdge is not, but where one shines, or one doesn't do something, it does better in other things. So let's just start off from the top. So here is a Thinkorswim chart, okay? And let's put the QQQ on the screen. All right. Now on the Thinkorswim platform, you can run strategies, basic strategies. Oh, sorry, you guys can't see the edge. One second. Uh, actually, why can't you see the edge? Oh, you can. I just can't see it in the recording. Sorry. It's not, that's just an optical illusion. Okay, one second. So make sure this is in the right to about there. Okay. All right. So yeah, my recorder didn't record as far over as I thought. Okay, so everyone can see the chart. So here's what I'm going to do. I'm going to go up here, edit studies. If you don't have Thinkorswim, don't worry about it. This is just an experiment. Okay? I'm going to go to strategies. Now, what we're going to do is we're going to choose, um, Cynthia, click on the, um, hold on for a second. Uh, you see at the top of your screen, there's a series of, it looks like a cross is pointing inwards. If you click that, you'll be able to see the entire screen. It looks like a cross that has like four arrows pointing inward. Yep, okay. Now, let's just do a quick experiment, all right? Very easy experiment. Let's choose a strategy to run. So I'm going to choose MACD, not because it matters, but I'm just going to choose the MACD strategy. This is a basic strategy that exists in Thinkorswim. All right, now I'm going to hit apply, and let's see what the outcome is. Let me also do something else. Let's make this today only, and let's change the settings on the chart so it does not have the extended hours, only the day session. Okay, there we go. So according to Thinkorswim, if we ran this strategy today, we would have lost $123.38. Now, I could change the settings. I can make it into a weighted moving average or a Hall moving average. I could do whatever I want. And maybe one does better than the other. But either way, the result here is that I lose. Okay? Now this strategy is able to go long and short. So it has some short trades and it has some long trades, some buys and some sells. Let's do a little experiment here. Okay? So I see the market's going up. What would happen if I do this? I go to the strategy and it has the ability to do long and short, right? LE is long entry, SE is short entry. So what if I said, all right, I want it to buy to open, so I'm going to put buy to open, boom. And now I'm going to go here and I'm going to force this to do something where it can only use a sell signal to close a position, but it will not go short. Let's see what happens now. Now I'm up $193. Now how could that be? All right, well let's just try this again. All right, so I'm up 193. I haven't changed the settings, so other than these. So let's say I do this to close and I shift this to open. So now I'm only going to take short positions, and when I get a buy signal, that's going to exit my short. Now I'm down $265. Interesting. So what this is showing is that short trades using the strategy are losing at a much larger pace than the long trades are winning. That's why when I have it long and short combined, I have a net loss because the sells are losing more money than the buys are making. Everybody follow me so far? Any questions so far? Okay. Well, maybe this is a fluke. Maybe it's just working because I chose this particular stock. Yes and no. There you go. All right. Let's try something else. Let's switch to one of the stocks on the screen. Let's go to NVIDIA. Okay. All right. NVIDIA, we have a loss of $453.77. Where do I see that? It's right here at the top. Okay, right below where my cursor is moving, it says FPL, and it says 453.77 in parentheses, which means it's a loss. So let's do our experiment again. Let's go here, and I'm going to make the short entries. Well, first I'm going to make the long entries to open and the short entries to close. Right? So there's no short selling. All I'm going to do is buy when there's a buy signal and sell when there's a sell signal. I hit apply, and now I'm up $213.99. Okay, so let's switch. I'm going to make this to close to the long entry, so that means it's going to exit as short, and I make the short entry to open. I'm going to hit apply, and now I'm down $651.80. So once again, the short trades are losing at a much greater pace than the long trades are winning. So if I have it going long and short, both, I lose money. Okay, let's try it again. Another stock. Let's try T-Mobile. Maybe it's just a fluke. I don't know. Maybe it's just a coincidence that this is happening. Okay, so T-Mobile is down $98.28. This is all based on 100 shares, so it's not weighted by trade size or anything like that. So the actual exact numbers don't matter. But let's switch it up. Let's try it. So let's go to open, to close. So we're going to go long only. We're up $74.36. Okay. Then I'm going to swap it to close to open. So we're going to go short only. Now we're down $172. Interesting. Okay. Maybe it's just the coincidence. It's just the stocks that are on the screen. That must be what it is. It can't be real. There's no way. Okay, let's try Adobe anyway. Maybe Adobe is going to be the one that's going to disappoint us. All right, Adobe down 115.62, going long and short. But let's do that again. To open, to close, okay, apply, up $405.50. All right, let's swap to close, to open, okay, apply, down $520. Name any stock that's bullish today. We'll run the experiment. AAL was one that was mentioned. Is that bullish today, Branton? Okay, let's try it. AAL. Not extremely bullish though. This is vaguely bullish, but let's try it anyway. All right, so we go here to open, to close, okay. That one's down to $1.54. Switching over to close, to open, okay. Now it's down $29.94. So again, the long side still lost on this, but that makes sense because this is pretty choppy. But nevertheless, it didn't lose nearly as much as the other side. The other side lost by a factor of about 25 times as much money as the other side. In other words, we basically broke even on longs and we lost clearly on shorts. Okay, let's look at another stock. Let's look at AMD. Shorts are already on, so this is going short only. Losing $132.11 going short only. Switching it to going long only. So to open, to close. Now we're up $289.89. Now, I can assure you, I can go through every stock that was bullish today that was significantly bullish, not barely going up, but things that were actually trending really well. We can go through every one of them if we want to. All we're going to find out is that when the stock is going up, whether it's Tesla or AMD or whatever, if I bias my trades to buying, I most likely make money. Let me repeat that. If the stock is going up and I bias my trades to buy, I most likely will make money. And it doesn't really depend on the strategy as much as you think. It depends on the stock and what it's doing, which is why I've said repeatedly, the stock does the work. The stock is what's going to make you actually win or lose by what it does. It is not how great you are as a trader. It's how consistently you go with what works. So, guess what the majority of the people who lost today were doing? What do you think they were doing, folks? The majority of people who lost consistently today, one person in particular lost 100% of their trades. Exactly. Going short, fading the trend. Fade, fade, fade. Some people did both. That's true too. Okay. So, as I've found consistently, Branton, I just got to say this, don't take it personally. People who fade the market usually think they're very smart. People who fade the market usually, in their minds, think they're very smart. The market, however, is dumb. So if I go against the market and I'm smart, it doesn't matter. It would be like trying to match wits with the zombie. The zombie doesn't care how smart I am. They still want to eat my brain. They're not going to listen to me if I try to explain to them the virtues of not eating my brain. They're still going to want to kill me. Are you guys getting this? What makes a great what makes a great monster in a horror movie is that the monster doesn't care. It's not affected by your crying, your screaming, or whatever. It just kills you mercilessly. That's what makes a great monster in a monster movie. If you ever think about the worst monster movie, that one that scared you the most, if it ever did. What was the thing about the monster? It was relentless. It didn't care. It took people out with no remorse. Now, you also have smart horror movies, like It. You have those types where they're actually smart. They actually manipulate you, take advantage of you, right? My experience is the feeling is always different when you're dealing with, depending on what you're dealing with. In other words, serial killers are scary because, they can deceive you. They can act like they're normal, but then they're hiding something. That's very frightening, right? That's something that we all naturally fear. But we also fear being in the cage with the lion because we know the lion, I can't negotiate with the lion. I can't do anything. The lion is going to kill me if it decides to. I could try to fight it, not likely to win unless I got a weapon powerful enough to take down a lion, which that would require at least a gun, a powerful gun at that. You know, the market is more like the merciless monster. It doesn't think, it doesn't feel. It's kind of like the blob or something. It just takes you out if you let it, or you can run with it if you want. If it's going that way, okay, you go the same way. You don't fight it. You don't say, I know where it's going to turn around. I admit that there's an attraction to trading reversals. Believe me, I get it. I really do. But I found that reversals are tougher to do than going with the trend because you really have to know why the reversal should occur. There has to be something very specific, something very clear that you're referencing. Now, I've said before that if you see that there is literally a wall above a particular stock, and it's a big one, big enough that this is not going to be something that the market can get through right away. In other words, if I see 500,000 shares of Apple for sale, that's something I can reliably guess is going to stop the market from going up. I can say that that's going to be more likely than not. That's just a probability. But I have to wait for something like that to do it. In other words, if I'm drawing lines on my chart and saying this is resistance because yesterday or the day before the market didn't go any higher than this particular price. Okay, maybe it is. But the problem that I usually see is how quickly people get out when you're trading against the trend. If you don't nail it exactly right, you got to get out right away. You can't let it go any significant distance against you. You must exit immediately the moment it doesn't keep going your way. Meaning that if you're trading against the trend, either you nail it or it fails. Either you get it almost exactly right or you're dead wrong. You don't have any in between. So what's happening is a person will get short. Let's say on Apple, it's right up here. And I say, all right, let's say it's right where my cursor is right there. Let's zoom in. So let's say it's right here. And I say, this is as far as I think Apple's going to go. And then it goes up. And then it goes up some more. And it goes up some more. And it goes up some. Now, eventually it does come down, but wouldn't it have been, the point is this. If I got short here, the moment it starts to go a little bit the wrong way, I'm wrong. That's it. I'm done. I wait. Okay. That kind of looks like it's the top. Okay, I'll sell again. This time I got it. If you're going to trade counter trend, you can't stick around for long. You take the shot. If it doesn't work, you immediately exit within a second or two. You don't wait and wait and wait and wait while it keeps going against you. This is one of the reasons why counter trend trading is so hard to do well, because most of us can't accept the loss and we don't want to admit it, but that's the way we are. Now, for me, I'm going to try to take the path of least resistance. If I know that I'm not good at managing risk, why would I keep trying to manage risk in the most difficult situation of all? Why wouldn't I try to do it in a more congenial situation where things are working more in my favor? Okay? If I'm going to try to fade trends, which is what people say, that's just the term people use, fade it, I'm fading it. If I'm going to fade, then it's in my best interest to be quick to get out if I'm wrong. I have to have a very small window that I'm willing to play in. So anytime I take a counter trend trade, the actual amount I let the stock go against me is always very, very small, extremely small. Meaning that if I'm trying to short sell Apple because it's coming up against a major price level that I know has large amounts of sell orders sitting there. They're sitting there, they're waiting there, it's clear. The most I'd be willing to let it go against me is about 15 cents. That's it. The moment it pulls through that level, I'm assuming I lost. I may not have lost. It may still come back, but I'm not going to hang around until it comes back. I'm not going to hang around and wait for it to come back. I'll get out, and if it keeps going up, good. I'm glad I got out. If it starts to turn around, I can always short it again. I can always come back and try it again. But but the same thing is, if it turns around, starts to go, okay, then I got to get out again because I timed it wrong. But when I'm trading with the trend and I'm randomly choosing a momentum-based strategy that I know for certain has no particular edge, in other words, if I play this out over time, it doesn't generate results any better than what I would have gotten if I just bought and held Apple. This is something I can prove. You can run back tests on any strategy you want, base it off of, let's say, 100 shares at a time, run it for 5 years, let's say, and then compare it to what would have happened if literally you just bought 100 shares of Apple 5 years ago and let it run. I can pretty much guarantee you any strategy that you've seen on Thinkorswim is not going to outperform what the market would do itself. And most of the strategies on Thinkorswim are the exact same ones that most of us are trying to use because we believe that if we just tweak it a little bit, if we add this bit, if we take away that bit, somehow, some way, it's going to generate much better results. But it's not. It's just going to perform almost exactly as well, usually worse, than what you would do if you just bought and sold or bought and held the stock. Now, again, I'm not saying this stuff hypothetically. What I'm saying is if anyone wants to actually challenge that statement, I welcome you to do so because that will be good because now you will see what I'm talking about. I'm not the first person to figure this out. I didn't figure it out anyway. I had to prove it to myself because I had too many doubts in my head. So I did the natural thing that you would do if you're trying to prove something. You go and prove it. You go and actually try it for yourself. You say, okay, let me run this strategy for 10 years on a back test, just like this. Go here. I say, all right, this guy says 10 years, I'm going to get the same result basically if I use this strategy than if I don't. Okay? Well, we'll see about that. All right. So let's see if I'm right. So here's the MACD strategy. And we got it on to open. So we're only going long, no shorts, just going long. Let's see what it looks like. It's 10 years of Apple. We have a gain of $8,892.29. That's our gain. Okay? Over 10 years for Apple. Now, let's just do this. It's going to create a strategy. Buy, hold, 10 test. And I would say, okay, all right. Now, what should happen is it should just buy. Oh, actually, I didn't give any conditions. One second. I got to give an actual condition. One moment here. This part I always forget the order. All right. Oh, crap. Did it wrong. Right here. What am I? Oh. All right. So let's just say close, close. Let's say, wait a minute. Open greater than 0. Add order. Oh, because I did it again. Sorry. I'm doing some typos here. Where's my MACD strategy? I forgot the the code for this. Okay. So what I'm going to do now, there we go, is I'm going to create a condition which says open greater than 0. That's the only condition. If the open, no, it doesn't. They can't do stuff like that. It doesn't look at time and sales or level 2 data. It only looks at charts. That's it. So the condition is simple. It's going to buy if the opening price of the stock is greater than 0, which of course it has to be. So it's going to buy right away, and it'll just say buy hold. Okay, there you go. Apply. Now, guess what the P&L is for this one? Let's just look back so you can see where the buy is. It's right here. First bar, it actually buys at the looks like at the opening price. So it bought here, 100 shares, and the price was, it says bought to open at $16.61. That's at the very top, where you see that kind of like the purple text at the top line. Okay, so it just bought, and it's held ever since then, and we're up $15,711.39. But again, if we looked at the MACD strategy, we weren't up anything close to that amount. What were we up? MACD strategy. Oh, sorry, I got to make it long only. But anyway, this is $12,000 long and short. And if it's long only, to open to close, okay, we're going to be up $13,000 if we're long only. Actually, why didn't it give? Oh, because I changed the moving average type. That actually was why. Okay. So what's my point? Did I beat the return on Apple? No. If I just bought the stock and held it, I would have been up 15,000. But because I did this, I'm up 13,992, meaning that this strategy has no advantage. Simple as that. In rare occasions, it may actually generate a slightly higher return, just not likely to. Most cases, you try this, the vast majority of the time, the strategy is going to underperform the market. Yeah, that too. The reason I'm pointing this out, folks, is simple. Okay? If I trade with the trend, what I'm trying to convince you is that the stock does the work. The strategy, if it's a good, if you have any edge in your strategy, it has to exploit what the stock actually does. meaning that there has to be something the strategy is able to do to recognize that it can exploit that would make it superior to just buying and holding the stock. Yes, and this doesn't even include fees. If I included fees, trust me on this, the result would be a lot worse. It would be quite a bit worse. It wouldn't be as bad as you think, but you would probably shave another $2,000 off of that number. There's a way to do that, by the way, in any strategy. You just have to write in the code to adjust the entry point by basically you would buy at a penny higher price and sell at a penny um, lower price. That would actually adjust it. Anyway, my reason I'm pointing this out, guys, is simple. Okay? Most of us, as long as you can make a profit, that is actually all that counts. In other words, to become funded as a trader, you don't have to beat the performance of the stock. That's not what we're asking you to do. We're asking you to make money. So even if you don't do better than what you would have done, in other words, if you just bought the NASDAQ this morning and held it to the end of the day, you probably made more money than if you were in and out of trades throughout the day. This is true. But we don't require you to beat the NASDAQ on the day. We just require you to make money. You have to make enough money to justify getting funded. Otherwise, what's the point? Right? If you can't make money, giving you money is not going to suddenly make you start. You're not going to start making money just because you got it. You're going to make money because you understand how to manage money already. So when you go live, you follow through with the plan that's already proven that it could work. It's going to be harder when you trade live. That's a given. But if you can do well in the challenge, which you would have to in order to pass, then we know at least at minimum you have the potential of becoming successful once you're funded. We don't know that for sure though. So it's up to everybody to kind of accept a few things. The reason I'm showing you this is that if the strategy can actually generate a better overall return than what you would generally get just buying and holding, it's not always going to outperform, but if it can generally outperform, then that's something you want to keep doing. Now, I do know for sure there are things that do generally outperform. Number one, if you pay very close attention to the order book, you should be able to more effectively enter and exit trades. You should be more effective at recognizing where and when to get in. If you follow the overall trend, it doesn't mean you're necessarily going to beat the performance of the stock because we don't know what the stock's actually going to do until it's over. In other words, 10 years ago, it's not like the Apple stock said, hey, by the way, guys, in 10 years' time, I'm going to be at this price. It doesn't do that. We find out what it's going to do. The point is that as long as I can successfully navigate what's going on to where I'm making some gains, then it's fine. So in other words, there's no need to run this strategy on Apple as a trading strategy because it's not generating any superior results. I'd be better just buying the stock. But perhaps if I run it in a different scenario, it might actually perform better than the stock would. In other words, it might just come down to the scenario that I'm exploiting. In other words, if a stock like Apple, which has large growth projections and things like that, perhaps that's not the right stock to use this on. But maybe if I use it on something like IBM, it might actually work better. Let's find out. So here's IBM. You make $2,377.97 over a 10-year period, but I can pretty much guarantee that the buy and hold is probably going to lose money. Let's see if I'm right. And I'm right. Buy and hold loses 6,992. Now, there's an example of where that strategy actually has an edge over the stock itself. Why? Because the stock's not actually going up, it's going down. So what am I getting at? What I'm getting at is If I know the ins and outs of what I'm doing, if I have a strategy that I know works well when something like this is happening and something like that is happening, then I might be able to make some money. If I know that once the stock is on a really good trend, the best thing to do is just ride the thing out, maybe reduce my position slightly when it looks like maybe the stock's about to sell off or then starts to recover. Okay, maybe add some more to it, maybe pyramid up if it keeps going my way. Those are things that can actually give you an advantage. You're never going to know what the stock is actually going to do until it does it. But what I'm getting at is if I'm trading with this trend, why would I want to fight against it? Why would I want to try to figure out when it's going to stop so I can go short? Why not wait until it actually is breaking down before I go short? Why don't I let the market signal that it's reversing before I go the other way? Not just assume that it will. Right? So right now, there might be someone thinking, yeah, the Nasdaq's going to sell off. These are things that creep into our minds because we hear people say this stuff so often. There's this belief that when you're a professional, you're supposed to go on TV and say, hey, the market's about to drop at the end of the day, and then it does, and everyone's like, they knew it. Did they? I can suspect that something's going to happen, but to trade it, make money is another story. It has to start happening before I can actually make money, and I have to be able to manage that position well. Which so I don't try to guess. I know I can say like it looks like the market may sell off. I have a suspicion it might, so be careful. That's one thing. Saying, man, these guys, I think they're going to sell this thing off at the end of the day, so let me start getting short. Okay, well, where are you going to get out if it's not going down? What's your profit target? Where do you think it's going to go down to? Why do you think it's going to go down to there? Just a hunch, just a guess, isn't a strategy. That's just me throwing money at the market and because I have a feeling something's going to happen. But if I'm looking at it objectively and saying, well, so far it's going up, so we'll see. I love using the word we'll see because, or the phrase we'll see because that's the way I have to see it. I don't know until it starts to do it. If I have reason to suspect that something might happen, I'll voice the reason I suspect it, but that's not the same as saying this is what will happen or this is what I should be doing now. It's just watch out for that. Maybe there's a chance that this might happen. Let's be careful or let's watch for that. Maybe the market's about to turn over. It looks like it's about to turn over. Let's be careful, or let's see what happens. That's just a heads up. But if the market doesn't respond the way that I anticipate or expect it, no problem. Like I said, Sam, when the market's really going and changing direction, you don't have to ask that question. It'll be obvious. It'll go this and then suddenly that. That's it. Whether or not it's going to keep going down, you don't know. All you know is something strongly changed. Just like when we look at it and suddenly you see this sharp drop down and then it starts to fade away, that's the market saying to you, yeah, I've changed my mind. And there's a good chance I'm going to keep going lower. That's all you know at the start. If we're waiting for quote unquote confirmation, you won't have it until it's already down to where you wanted it to go. So again, we're not trying, there's nothing wrong with trying to anticipate a reaction in the market. That's what you should be trying to do. We have to anticipate things. That's the only way we can make money. We have to anticipate what's going to happen next. But we base that on what we're observing now. And the better our observations are, the more likely we're going to be correct. That's all we have. We don't have assurances or guarantees or foreknowledge. What we have is observations and experience over time that suggest a likely next action, a likely next result. As long as we focus on it that way, we're more likely to do well. So the reason I'm bringing this up with the back testing is just to show the point. If the stock is on a really good trend up, trust me, you can buy at random and most likely you're still going to win. That's it. If you randomly buy in an uptrending market, chances are you're still going to win. If I program a strategy that says simply, if a bar goes down and then the next one goes up, buy. Even if that strategy is not that good, it will still generally work in this environment because mostly the stock is going up. That's all. It has nothing to do with how smart the strategy is. It has to do with the fact that I'm looking at what the market's doing and I'm choosing to get in to the direction that the market clearly is going. It's been clear since the open which way it's been going, and it's just done more and more of that as the days gone by. So we already knew the market was bullish way over here. We didn't know how far it's going to go, but we knew it was. So therefore, if I say, all right, here's a little pullback, I'll take a small risk that maybe it's going to continue. Oh, it continued. Oh, it's really continuing. Okay, it's starting to pull back sharply. I'm not sure if it's going to keep going. Let me reduce a little bit. Oh, wait, it's turning around. Okay, let me kind of leverage up again. Okay, now I'm not sure what's happening. Maybe I should reduce my position a bit. Okay, I'll reduce my position, keep reducing my position, keep reducing my position, keep reducing my position. Okay, wait, it's starting to turn around. Oh, wait, it's going again. Okay, all right, let me start increasing my position a little bit. Okay, maybe a little bit more, maybe a little bit more. Okay, it looks like it's going to sell off. Let me reduce, reduce, reduce. Oh, it's starting to go up. Okay, let me increase again. This is actually all you do. Not because you know what the future is holding, but you see the overall pattern is there. So why fight it? Why try to be the person that calls the top? And what do you get? If it goes down, think about this. What are the chances that we're going to retrace from here all the way down to there? Is that really likely to happen in the next 12 minutes? No. But if I win on a counter trend trade, the most I can expect is a little bit of money. So I better take a little bit of risk, a very little bit of risk. Because first of all, I'm most likely to lose anyway. Second of all, if it does go my way, it's going to be a quick move my direction. Hopefully, if it's gradual, I get concerned. But if it's quick, great. And I should be getting out ASAP, not holding on thinking, oh, it's going to come all the way down to here. No, don't expect that. If it's going to sell off, it will signal it so clearly. It just will go down. Not like, kind of going down. No, it will sell off. If you see out of nowhere, volume spikes, sharp decline, something just happened, probably the market's going to go down at that point. That's the only time I would even realistically expect you might retrace all of the ground that you just covered. But if it's just casually moving down, that's not any indication of a sell-off. That's the way the market normally behaves. So, guys, remember, just use your common sense. I mean, when it comes to this stuff, a lot of times common sense is correct. That if something doesn't look like it wants to go up, trust me, it probably doesn't want to go up. If something looks like it's struggling to gain, that's because not everyone's convinced it should be going up. If something is moving in a very orderly fashion, up or down, there's a reason for that. The reason is most of the trading world is convinced that that stock should go down or go up, depending on which way it's going. Now, right now, we've got some pretty big imbalances, by the way. Apple's got nearly 1 million shares at the close. Looks like the market's not. Looks like the market thinks these prices are a little on the high side, so we should see a slight decline here as we go into the close. As long as these imbalances stay there, it'll start to get more intense. So some of you asked that question, what are these things? Imbalances are, you have market on close orders, and essentially this is showing a lot of red. And as far as size is concerned, this is mostly selling that I'm seeing. Except as you get to the middle, it's actually a good mix. But at the top, it's mostly red. So that means you have a lot of people trying to sell on the close. That makes sense because the market's really up. Unless they think that Monday is going to be really bullish or the weekend is nothing to worry about. With this much of a gain today, probably you want to reduce a little bit. But that's just an opinion. I don't know for sure if that's why they're selling. So if these imbalances persist all the way up until the final minute or so, usually the market starts to decline sharply. However, if these imbalances disappear, the sell imbalances that are bigger, then things will just kind of normalize. It's mostly the bigger stocks like Apple, Google, and Amazon. You got to watch those. These are pretty large imbalances, larger than average. Usually they're going to be like 80,000, 70,000 shares, 40,000 shares. So this is tenfold what's normal. Probably won't last very long, but we'll see. Okay, so right now the market is still waiting to see if these disappear or not. If they do, then everything's normal. If they don't, and worse, if they start to get bigger, then we'll probably see a quick sell-off because the market's got to anticipate that the price has to drop of the index because too many stocks need to be sold. Yes, that's right, Scott. So this is the pair quantity. The pair quantity means how many shares have already been matched up, and this is the remaining balance that has not been matched. In other words, there are 879,000 shares of HBAN that are supposed to be sold at the close, and so far only 711,000 have been matched up, meaning that this stock has a very large imbalance going into the close. Large enough where that can move the stock price down very sharply if they can't find matching orders. Now, we don't trade this, unfortunately, because it will require us to trade past the close. But at the opening bell, you have the opening imbalances, which it works the same way. That you'll see the imbalances pre-market, and if they're really strong on a particular stock, then it tends to move the stock in the direction of the imbalance. So if the imbalance is a huge sell imbalance, the stock tends to go down. If the before the open, that is, and if it's a big buy imbalance, the stock tends to go up before the open, and then they basically have to match up whatever's there. So this is the current imbalance, and this is how much has been paired up. So if you look at this total numbers here, that's the total sum of what the imbalance was. Okay, so HBAN, you see it just kind of went down the list here. So this stock took over. It has a big buy imbalance. This is being sorted by number. But, oh, the heck? What happened there? One second. Why did that disappear? Huh. Yeah, I don't know what happened there, but I'm supposed to see all the data. Did I do something wrong? There you go. Yeah, I don't know what happened there, but there it is. Yeah, I guess that's what I did. I don't know how I did that. That's actually interesting. I know you can zoom into one. Oh, maybe that's what I did. I might have clicked here. Nope. Okay, yeah, I don't know. I don't know what I did there. So that's just interesting stuff. At the opening, this is where you can exploit this stuff if there is a really big imbalance. Usually there's not, but sometimes there is. So Apple had a big imbalance, but it looks like it's been matched up. Yep. So look at that. Apple was at 500,000. Now it's only at 12,000 shares outstanding. So that's nothing. Not even important. Amazon. Okay, Amazon. Oops. Amazon has 411,000. So it still has a pretty good size. It looks like a buy-in balance. Yeah. So, man, why is this acting so strange? Okay. Sorry. I don't know why this thing keeps doing that. All right. So, yeah, that's all there is there. All right, folks. So, in summary, in summary, if you trade with the trend, you'll tend to make money, which is the reason why I suggest to only look at stocks that are clearly trending, the ones that clearly show a strong bias, that keep pushing in that direction, up or down, that look the cleanest on the chart. You want to pick the best looking stocks, literally. Be very what's the word? Be very selective. Okay? Be very selective. It does not pay in this game to be accommodating. You only want the stocks that look the absolute best. They're looking the part. They're trending the strongest. They're the least. They have the least deviation. They're pushing, pushing, pushing. That's the ones you want. Everything else, skip. Meaning that if I'm looking at investing into stocks and holding them, I want the company that shows the greatest potential to increase in price, do I not? So if I'm looking at two companies, one is IBM, one is Apple, although they have a lot of good things going, they're both successful businesses. If Apple looks like it's going to be the bigger growth prospect, that's the one I want. Now, no one knows for sure until it's over, but stocks move based on fundamentals. And if everybody, if you look at the results for IBM and their growth projections, et cetera, over the last 10 years, it'll be obvious why IBM stock has not increased, but Apple did. Apple grew as a company, big time. IBM could not, and it didn't show any signs that it would. So, forgetting the chart, if you just looked at the fundamentals and the numbers surrounding that company, it would have been pretty clear which stock was going to be the performer. Okay? Or at least which one was more likely to be the performer is a better way of saying it. So, once a stock is on a trend, it's there for a reason. People need to buy for some reason. There's a reason why Apple stock looks much better on a long-term chart than does IBM, because people were very convinced to buy IBM, or sorry, to buy Apple. So the trend is also a reflection of intention. It's a reflection of conviction. So if I see something that's trending very well, that's the sign of strong conviction. That's the sign that people actually want to buy, not sell. So if I'm going to be the guy that comes in, or the gal that comes in and says, I know the entire market is buying this thing and they got the money to move it up, but what I'm going to do is stand right in front of that tidal wave and I'm going to stop it. Just like that video of the guy that stands in front of the train thinking that he can psychically stop it. Well, yeah, that didn't work. So when the bulls are running, you can try to stand in their way, but you're just going to get run over.